So if you're a parent like me and you do bring your children to a pediatrician to, get them sorted out for their coughs and colds and their fever, I'm pretty sure you bring home some souvenirs in the form of ethical drugs like the paracetamols of the cough medication. And if you pay enough attention, there's this similar brand that is across a lot of pediatric clinics within Malaysia. This brand called Vaxel happens to be owned by a listed company called Kotra Pharmaceuticals, and I'm going to talk about this company today in this video. As a disclaimer, whatever I say or share in this video is purely for educational purposes only and is not constituting a buy or sell recommendation. And last but not least, I do not own any Kotra shares at the time of this recording. So first off, their business model. They are in the business of manufacturing and trading pharmaceutical and nutraceutical products. In very layman terms, they manufacture generic drugs and also supplements that is sold over the counter in most pharmacies in Malaysia and in countries where they have a presence. Their main market is still very much in Malaysia, and you can often see their products in chains like the Carings, the Guardians, and the Watsons of this world. They currently have a presence in roughly about 30 countries, and based on what the CEO said in an interview with The Edge, they wouldn't likely penetrate new markets because 30 countries is quite a lot of presence already, but they plan to deepen their presence within the Asian region. So why are generic drugs manufacturers important? First and foremost is definitely the cost, because it can lower the brand name drug by almost 85% in terms of pricing. So let me give you an example. One of the earliest manufacturers of Panadol, which is GlaxoSmithKline or GSK, their drugs are 85% more expensive than the normal generic Panadol or paracetamol, or whatever you call it, Euphamol, right? And it leads us to the second reason why generic drugs play a very important role is because it increases the likelihood of a patient that has a recurring drug regime to be able to consume it and to maintain their health. Because just imagine if your drugs cost 5 times more, and in an inflationary environment like today, the likelihood of the patient willing to fork out that cost will actually decreases as prices of other things that are more necessary in his life, like food, clothing, and all these things increases. Last but not least, according to the FDA, generic drugs are almost as effective of their branded counterparts. So in a way, they help alleviate these branded counterparts, reduce the manufacturing costs. They outsource a lot of these patent drugs that have been off patent to the generic drug guys, where they can continue to focus on blockbuster drugs and pour more effort and resources into R&D making new drugs, and allow the generic drug manufacturers to expand that reach of these off-patent drugs. So let's now cover an overview of the finances of Kotra. Looking at it, just be aware that their financial year end is in June of every year. So for the trailing 12 months or last 12 months, as of the most recent quarter, they made roughly about 207 in terms of revenue, which is not a very big jump from the 2016 revenue. Just slow and steady kind of growth. Were they profitable? Yes, they were. Net income to company, net income 62 million. So in a way, they are making operating margins of roughly about 28%, which is quite healthy. As you can see, it's increased. From 2016, it was roughly about 8%, and then now it's increased to 28%, which is a good sign. I mean, even though your revenue growth is not substantial, but more importantly for me as an investor, I like to see net margins actually grow. On increasing revenue, it may not need to be supersonic, but yeah, there you go. Another example, if you've followed my earlier videos on FrontCan, you will see this same trend happening. Okay, let's now look. So we look at the cash flow. Operating cash flow wise, they grew from 28 million in 2016 all the way to 60 million. Okay, it's almost double. No, slightly more than double. Okay. Are they growing the business? Are they doing any capex expansion? Let's have a look at their capex. Okay, so 12 million, 3 million. So on average, low single digit kind of capex. And I think that for a generic drug manufacturer, a lot of it hinges on their manufacturing capacity. A lot of it is actually they have 2 plants in Malacca, And I do remember seeing they plowing a big amount of money earlier on. I think it was way back in 2008. I won't go through in this video, but they did plow a substantial chunk into building a larger than a needed kind of manufacturing capacity, because the requirements or the processes to get the approvals, you only need to do it once, even though they were spending more than what was needed a few years again. But today, most of their manufacturing capacity has been taken up. All the approvals are already necessary in place, rather than having a modular kind of growth for most electronic manufacturers. Now, in the drug manufacturing industry, it's slightly different. Is because there's a lot more stringent approvals from third parties. Whereas if you're a semiconductor, electronics kind of manufacturer, you need mostly your clients to approve the process. Whereas for a drug manufacturer, you need FDA approvals, you need your clients' approvals, and it's just slightly more stringent with more third-party guys coming in. And I thought that was a smart move by Kotra. So on the balance sheet, let's see whether they're healthy. Okay, cash and equivalent of 23 million. Okay, so let's just plot against, did they obtain this by actually tapping the capital markets? And they did, but not as much, because if you see 66 million, 84 million, not really selling shares, but mainly from organic growth, cash flow from operations that they generated this cash pile. So it's pretty good. Net cash, let me see. And the net debt, yeah, they're a net cash company. So going forward, I think they're in a healthy balance sheet, and they're on sound footing with a lot of their manufacturing capacity already built in based on their earlier investments of capex. So I hope you're enjoying the video so far, and if you do and it has brought value to you, do consider subscribing to my channel, give it a like, share with your friends and family to help them build better business mental models in their investing journey. Another thing that piqued my interest while looking at the financials for Kotra was actually their dividend yield, roughly 3.4% as of recent times. And they've been pretty stingy in the past. They've never paid a dividend for close to, let me see, if I look at 10 years, oh, they did pay. I think they stopped in, stopped in 2020, and it was negligible all the way, and then all of a sudden, pop, they paid dividend in 2022. So I think they've accumulated quite a healthy balance sheet, some cash. I think they've depreciated most of the plant that I mentioned earlier, where they overspent on the capacity building up many years ago, just to get rid of all the hassles of approval. And now I think they're comfortable enough to start paying dividends on their operating cash flow being generated from the business. So how do their relative valuations look like against their pharmaceutical peers in Malaysia? Now, Kotra isn't the only generic drug manufacturer in Malaysia. In fact, there are other guys that actually have some sort of a monopoly in terms of supplying to the government, like Duo Pharma and Pharmanyaga. But in terms of the private ones, Kotra, Apex, and Yungshin Pharmaceutical, or YSP, they're considered their peers or the competitors. They look a little bit expensive if you look in terms of relative valuation, which is the trailing PE. For current year 2021, 24.9, or roughly about 25 times. But going forward, for the forward PE of 23, it looks pretty decent at roughly about 11.5 times. Their peers like Apex, wow, 20 times has never been cheap, 27 times. And even the guys who have the monopoly of the government contracts are trading in somewhat a region of the low teens. So these are the relative valuations if you want to look at them compared to their competitors. So next up, what are the risks that we need to look at when we invest into Kotra? So I'm going to categorize them into four main risks. Definitely there's a more exhaustive list, but I think these are the four main ones that I see. The first one is actually the softening of consumer spending and actually the sentiment today. I mean, a lot of people believe we're already in a recession, and a lot of these, how would I deem, nutriceuticals or supplements are considered discretionary spending. And these discretionary spendings will likely be the first off the list when people are going to tighten their budget. Now, it leads me to my second risk, which is actually Kotra's over-dependence, whether you see it positively or negatively, on their one brand, which is Epiton, because Epiton makes up 60 to 65% of the revenue generation today, and that dependence on one big brand, it's somewhat of a risk. I personally don't really see it as a risk because brands take time to build, and it's built over time, and people trust that brand. However, if there is, let's just say, drug poisoning, for the lack of a better word, and it involves this brand called Epiton, then that trust reputation is down the drain, and it's gonna be quite a big impact, because 60 to 65% of their revenue, right? But the probability of that happening, very, very, very little. Okay. The third risk I see is the sharp rise in input costs and depreciation of the ringgit. A lot of their raw ingredients are, while they are manufactured locally, a lot of these ingredients, the active ingredients, are actually sourced either from China or from the States, and it does have a bearing, especially with a depreciating ringgit. However, I think that is the prudency of the management to how to adjust, how to hedge forward a lot of these costs, and I think that's something that is within the power, not to say fully, but still within the power of good management to balance out the costs. Last but not least, and I think this one has quite a big weightage or bearing if it does truly happen. Now, the government is advocating for putting up ceiling prices for generic drugs, and they are currently in the midst of studying capping certain generic drugs, especially recurring drugs that have a bearing to those in the B40 or the M40 that needs to purchase these drugs on a recurring basis. While it's not very clear at this moment whether that will be capped for all generic drugs, but this is a regulatory risk that Kotra has to face. Yeah, in inflationary times, I think the government wants to be seen helping the public, and one way is to cap certain drug prices. So there you go, the 4 risks that I can think of. But definitely there's a little bit more exhaustive list, but these are the 4 main ones. So as a conclusion, I've shown you the business model of Kotra, in which they're in the manufacturing and trading of generic drugs as well as supplements. I've shown you the financials, quite a healthy balance sheet, very stingy in terms of dividends until the most recent times. In terms of valuation, roughly quite reasonably priced against their competitors, especially compared to Apex. And also in terms of the risks, the 4 main risks, with the highlighted ones being regulatory risks on capping of price ceilings for generic drugs. So if you think you've benefited from learning this through this video, please consider giving me a subscription, give it a like, consider hitting that notification bell when new videos or new businesses are out. You'll be notified, and do share it with your friends and family who want to start or embark on their journey of investing. I'll see you in the next video, guys.